Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into another episode of the Money Insights Podcast, where we talk all things money and business. My name's Christian Allen, and I'm here with my co-host, as always. You know him as Rodney the Pod Zabriskie. What's up, man?
Hey, I am doing great. Glad to be here. Glad for an exciting interview today.
Okay, so we were fortunate to have a great conversation with a longtime partner, Dr. Buck Joffrey, host of the Wealth Formula podcast and a serial entrepreneur. One of the things I liked about the interview, Rod, and I liked several things, Buck always has a lot of insights, but one of the things that stood out to me was this idea of focusing on investing in real estate, but doing it as a business. And really one of our core, kind of one of his core messages was that treating each of those things, like any opportunities more like a business, is really what gives you the opportunity to take things up a notch. So anyway, That was a really cool part of the interview.
Yeah. And I think that speaks of kind of the way that he has done things himself, just in terms of systematizing the real estate, but in other things as well. He hosts the Wealth Formula podcast and has other investment opportunities that he offers to people. He's obviously building kind of a community. He talks a couple of times in the interview about his investor club. And so he's kind of taken that idea and really made it work in a lot of different directions.
Okay, so Rod, we get into this at the beginning of the episode, but give us just a little bit of Buck's background before he became a serial entrepreneur and podcast host.
Yeah, so he is a former head and neck surgeon / plastic surgeon, and spent a few years doing that, and then kind of saw the light, came over to the alternative investing side, and in addition to becoming prolific in his investments, and like especially with the real estate, he started the podcast, Wealth Formula podcast, and again has built this community of like-minded people who are all kind of pursuing the same kind of thing. He does regular meetups. I think he talks about one of those at the latter end of the call. And anyway, he just has a lot of cool things going on.
Okay, Rod. Well, without further ado, let's get into our conversation with Dr. Buck Joffrey. We are very excited to have with us one of our long-term partners, Dr. Buck Joffrey, serial entrepreneur. Buck, thank you so much for coming on with us. We're excited to have you.
Of course. Thanks for having me.
Okay, so we're just going to dive right in, Buck. You didn't start out as a prolific real estate investor and podcast host like you are today. You were in medicine. Like, talk a little bit about how you got into medicine first, and then we'll move into the next jump.
Well, if you think about the way society is right now, like these days, right? It's always built in the US. It's like everybody goes to school, you go to elementary school, and then you move up to middle school and high school and all that. And it's almost like, this whole process was started, around the Industrial Revolution. So you can almost see it as this like conveyor belt, spitting out worker products. And along that conveyor belt, what ends up happening is, some products end up being a little bit better and some a little bit worse, and some end up, being the best products of the whole system. And that creates a workforce. And I think that's kind of this trap that we're in, especially for, I think, people who are really good students, right? If you're a really good student, I would argue that you have a major disadvantage to the entrepreneurial path. And here's why. What people love is to be accepted. People love to be rewarded and told they're doing great things. And if you're a great student and in high school and in college or whatever, you're just going to keep feeding off of that Pavlovian, feeding frenzy, right? Like, everybody thinks you're great. Why would you go off into some other area where you could potentially fail, right? And so that's kind of the trap I was in. So I was in the trap that I didn't even really understand what entrepreneurship was. So I was a good student, and then, I was kind of driven. So college, what are you going to do? I kind of like history. And then I was like, I can't really do anything with history. Let me do biochemistry and molecular biology. And then what do you do with that? Well, I could go in a lab and be kind of a, lab
You'd be a
guy.
scientist, right?
Yeah. Or I could be a doctor. Okay. So I guess I'll be a doctor. That's really what it was. Right. I guess I'll be a doctor. That sounds good too. Right. I mean, it sounds cool. Like, hey, I'm going to be a doctor. And then so I was in med school, and driving to med school, I was listening to a radio show, it was National Public Radio, and Dr. Ben Carson, who was a neurosurgeon, was
Yes.
being interviewed. And I never thought about neurosurgery, but I remember Carson saying that he said, somebody asked him, how'd you know you're gonna be a good neurosurgeon? He's like, oh, I have really good hand-eye coordination. Like, I'm good at ping pong and things like that. So here I am driving down the road, and I say, oh my God, I'm good at ping pong.
Wow, that's awesome.
So then we get to school, and I'm telling everybody's like, what are you going to specialize in? I'm like, neurosurgery.
That's hilarious.
Because I'm good at ping pong. It just makes sense.
Yeah.
There's I will say that I'll finish this part of the story just saying that came full circle when I actually interviewed at Johns Hopkins. I interviewed with Ben Carson.
Oh, wow. That's kind of cool.
And his junior partner. And I was telling his junior partner the story, and he thought it was hilarious. And he's like, hey, do you want to play play a game against Ben Carson? And he brings out one of those portable little foosball machines. Anyway, Carson has no sense of humor, so like
no going for it, huh?
I mean, he brought it out, but then he just kind of looked at him and he looked at me and he's like, yeah,
not happening.
He's a humorless dude. So I went down that pathway, ended up like I said, doing well and living the golden handcuffs dream. And then one day, finishing residency, I ended up finishing in head and neck surgery and plastic surgery. After I trained, I was kind of burned out of academics. I thought I was going to be an academic guy. And the next thing you know, I accidentally read a Kiyosaki book. I read Cash Flow Quadrant, and it's sort of ludicrous in hindsight to understand why that book had such an effect on me. Like it's so simplistic, right? But I think it's a paradigm shift. I think that's what it is. That's why it affects people. It's like, it's not like, Shakespearean prose or something like that. Right. I mean, but it's like so basic, and all of a sudden this finance world and stuff like that sounded really interesting. And so it sort of unleashed an entrepreneurial animal in me. And the next thing you know, I kept starting businesses and, ended up ultimately in real estate. And that's my story.
Buck, did you ever work for somebody else? Or because I know you started businesses like pretty soon after you were trained. Like, did you actually ever work for other people?
Yeah. So when I started by, so I went to the, complete dark side from the academic world, and I finished training, and there was this company back in the day called Lifestyle Lift, and they were doing like these facelifts, and they were saying they were not facelifts. And anyway, like, it was an opportunity to do an enormous number of facelifts in a short period of time. So like you could end up doing 600-700 facelifts a year. And that's something like, in the old days, that would be like very few doctors would do that in an entire 20-30 year career. So I took it on and I did it, and I was actually pretty good at it. And then that was another thing that ultimately kind of fueled me towards entrepreneurship. Is what happened was, like about 3 months into this, I'm like, this is great money. I mean, I'm making like literally 10 times more than I did as a resident, which isn't much, by the way. Mm-hmm. But wait a second, there's a guy at the top here, and he's the one who's making a lot more money than me. I should do something different. Right. So then I had this idea, maybe I'll do the same thing, but I'll do it with liposuction. And my wife at the time, my ex-wife now, but she's you're so I can't believe you think you can do this. This is so ludicrous. You're such an ego. And I was like, why? Why couldn't I do this? She's like, well, you've never even done liposuction. I'm like, so what?
You'll figure it out.
That
Details.
was the least of my concern. So anyway, I actually ended up building a liposuction business, and she never doubted me again. But and then I was like the busiest lipo guy in Chicago. And then from there, it just kind of took off and did other things. But to your question about did I have a job? Yeah, when they found out I wanted to do that, because I had a loud mouth and I just want to tell everybody, I was like, oh yeah, I'm going to do this. They just fired me because they're like,
all right, that's Buck's experience. Hired and fired, and he was like, I better go do something else.
It's about, I think I was dutifully employed for like 8 or 9 months.
All right. That sounds about right.
That's hilarious. Okay, so, but even after you went and started your own thing, you kind of described it as you're still on this conveyor belt. You have the golden handcuffs on because now you're making a lot of money doing it, right? So to walk away from it would be crazy, but you did.
But I did.
How did you end up at real estate? What was the journey there?
So here I am. So I did this this lipo thing, and it was making really good money. I was in my early 30s making over $1 million a year, and I was like, this is great, right? Yeah. And what happened though is that over time, like I was, I definitely had this bug. I like wanted to keep starting business, so I had like a lot of these little businesses I kept trying to do. I actually ended up starting another medical business that was very lucrative for a period of time as well, and I ended up with a bunch of money. So what do you do with a bunch of money at that point?
Yeah.
I bought real estate because Robert Kiyosaki told me to, right? And also because the reality is my dad's is in real estate. He's been in real estate for 60 years now. Mm-hmm. And to me, whereas a lot of people learn about real estate being the risky asset,
Mm-hmm.
the alternative asset, like has a nose ring and purple hair or something like that. To me, it was like the safe thing because that's what I grew up with. So I bought real estate, and I don't know. At first, I was buying apartment buildings on my own, and I was making, some pretty good cash flows and money, and pretty significant returns when I sold the properties. So then I got this idea that you can do things bigger and bring people along for the ride, and that's really how real estate syndication started for me. And the rest is history.
Okay, Buck, what advice do you give? You talk to physicians all the time, obviously. You attract physicians to your podcast. So like, what advice do you give to maybe not just physicians, but people who are wanting to try to move from a high income job to become entrepreneurial?
Well, I think first of all, I think that I would say don't quit your day job, because
make the money first, right?
Yeah. I think that the challenge is this. Okay. The challenge is that, it depends when you decide you want to do something. When I started out doing the entrepreneurial stuff, my first daughter was, just born. And I was like, you know what? I got about 18 years to figure this one out before I have to like worry about college and all that stuff. So I have plenty of time to screw up, Yep. And it was really calculated that way. Like I have plenty of time to screw up right now. So I'll just go and try it out. I think that for people who are like further along in their career, then you do have this issue with golden handcuffs. And I think it becomes very difficult if you're a physician and you're making $600,000-$700,000 a year, and all of a sudden you've got a couple kids who are needing to go to college pretty soon, and you can't just be like, oh, I think I'm going to quit and give it a shot here in the real estate thing. It's probably not a good idea. That's where you would with some real estate shows, it sort of sounds like that's that's a suggestion.
You do hear that a lot,
but I don't think it's a good idea. I do think that, again, looking at real estate as an investment vehicle, for most people, real estate is best as an investment vehicle, not as a job, right? And so, I think that's where, people who listen to me, who are in our, investor ecosystem, that's kind of where they fall. They're like, okay, I make my money, but I want to grow my money, and I'm interested in real estate. I'm interested in other kinds of assets. And that's kind of my advice. I think that that's a better way to go. Now, if you are just have a burning desire to be an entrepreneur, I think there is a genetic component to being an entrepreneur a little bit. Because my dad is one, and he was kind of crazy like I was. He was like doing all sorts of different things, right? I feel like I'm very different from him, but it's kind of frightening to me how behaviorally, when it came to business and stuff, we were the same.
that
But
is interesting.
yeah. But I think, if you're born an entrepreneur, like my friend, you probably know George Newberry, American Home Reservation.
Yep.
George is like, he's another example, and even more so than me, like born entrepreneur, right? And so I think it's kind of funny is that if you go and you look at the Argentinian airport, it's called George Newberry International Airport. And as it ends up, that was his grandfather.
Oh, wow.
Who was
this
crazy aviation guy in Argentina who ultimately crashed and burned, apparently. But it just goes to show there's a gene there.
That's interesting. Yeah.
That's
okay. So you start investing in real estate.
Yeah.
But then you kind of start taking it to a different level. You begin to develop this idea of the wealth formula, right? So your business obviously is called Wealth Formula, but it stands for something, right? So how did you come up with your wealth formula, and what is it?
Well, I think I don't know how I came up with it. I think I just put down what are the elements that I believe really can create wealth, and that you've got to have them. And if you figure this out, then you have a better chance of creating wealth quickly. So I borrowed from Newtonian physics, as a good student would do.
Good source.
And had them as a momentum equation, right? So it's mass times velocity. And so it was like momentum of wealth, right? But we can still use the mass and velocity terms. Mass is like, okay, how much do you actually invest? You got to put some money in to invest if you're going to actually make some money. I don't care what your returns are. If you don't invest much, it's not going to help. And velocity is a concept that's basically what your returns, your IRR, whatever. But the way I often look at it is how long it takes to get your invested capital out of a deal and into another opportunity, so that you're continuously multiplying the effect exponentially of the same capital going into multiple opportunities. And then the last component of it is leverage. And leverage is, for the most part, it's anything that can help you, if you think about it in terms of what a lever is. But in practical terms, it's debt. And it's good debt. And here's, I think, fundamentally where, conventional advice for individuals differs from what I say. I think a lot of people are really scared of debt, right?
Yeah.
But they don't really necessarily differentiate between what, Robert Kiyosaki would call good debt and bad debt. And good debt is essentially allowing you to make more money, amplifying your returns. And I will go as far as to say that I do not believe it is possible to move from one wealth level to the next, like a substantial level, going from being like a, $300,000 per year person to a $2 million per year person. I don't believe you can do that without using some level of debt. I don't think you can exponentially increase your net worth without doing it. And I think the only ways that, most people can get to the, higher echelon of wealth is by utilizing debt, unless you're an entertainer, a sports star, or something like that. So, but with, you think about like the way most people invest, right? And they just got money in the markets and stuff, and it's going 7-8%, whatever. Maybe if you're lucky, maybe you don't. But whereas in real estate, what we're trying to do is with the wealth formula is what we're trying to do is like really make those numbers pop, right? Like we want to try to double our money more than every 10 years or so. We want to try to double it in every 3 years or so,
And you guys have done, your investment offerings have done extremely well. We're going to talk more about that in just a minute. Buck, you were early on in the podcast space. So before we jump into kind of the real estate investor side in more detail, how did you get it, or what? I mean, you've probably been doing it, what, 5 or 6 years, and maybe like what inspired it? How did you get there? You were obviously early on and have done really well with it.
It's funny when somebody's early on and it's been like 6-7 years, right?
Yeah, right.
A pioneer in the space. So I started listening to podcasts, and and again, going back to this, like, I've got money in my pocket. What do I do with it? I don't know. Let me try to learn. And real estate sounded like it made a lot of sense, but my dad never really taught me anything, and I needed to learn. And so I was listening to a bunch of podcasts. And what ended up happening was that, like any given podcast, there would be one show maybe every 5 or 6 weeks that was actually related to me. Most of them were, getting out of your cubicle and all this other stuff. I didn't have a problem. I wasn't worried about making $100,000, right? Like that was not my issue. My issue was trying to place 7 figures per year. And so because I couldn't really find the solution at the end of the day, I was like, you know what? I'm just going to start my own podcast. And, I was young, had a lot of energy.
6-7 years ago. Back in the day.
Shoot. A lot of energy. And I did it. And I actually think I started it and did like 2 or 3 shows and then quit for like a year because what happened was the first 2 or 3 shows, I was like, how many listeners do I have? 5. That's me 4 times.
Oh, yeah, those are tough. Oh gosh. Yeah. Right. Well, okay. So thanks to you, Buck, we had the good fortune of not having to start out with 5 listeners.
Yeah.
We had a few people that already listened to you that came over, but it's a drag trying to get the wheel going, right? It takes time.
Yeah.
It's okay, cool. Sometimes. But you stuck with it, man. It's there's a lot to say to that. Okay, so we talked a little bit about alternative investing. Let's talk a little bit about why you like alternative investing as opposed to more traditional market investing.
I think that for me personally, what it just comes down to is what makes sense. To me personally, like, personal finance is personal. And so you have to figure out what it is that resonates with you. I'm not of this school that I think you say, I'm not smart enough to manage my money, so I'm going to hand it off to some other guy who's, got a 6-month course and all this and makes a lot less money than you to manage your money. Right.
Right. Yeah.
So I kind of look at the way I do personal finances. It's a little bit harder, right? Because it actually requires some level of effort, but that's the price you pay for, getting higher returns, in my opinion. So, why do I don't really have exposure to the stock market except for opportunities maybe I got into on a financing round of an IPO or something like that. Don't really buy stuff in the stock market. It's not, I won't say that I would. I mean, if the floor completely falls out again, maybe I do grab some, but and the main reason I don't is because it's not anything other than I don't really understand it. Just don't really understand it. Like, you know, the valuations of these, you know, tech stocks and things like that are so insane. And, you know, markets are going up and down based on news every day. It, I mean, it's funny because sometimes in, you know, as you know, in the physician ecosystem, they just make it seem like, oh yeah, you know, you just do this and you do that. And then you're going to end up with 3 or 4% per year to live on after that. But it's really not that easy, right? Like there's an entire market behind it. There are publicly traded businesses behind it. And so for me, I feel a lot more comfortable investing in things that I completely understand. I completely understand. Like, you know, as you know, we big component is apartment buildings. Our group's probably, you know, got $1.5 billion under management now. And you know, this is really obvious stuff, right? Like you get people need to live somewhere. They live somewhere. In order to do so, they pay rent. Okay, that's how it works.
Mhm.
Right? I mean, there's a valuation, certainly if you want to sell and buy this stuff, and those are based on cap rates. But fundamentally, the business model is pretty obvious, right? And so I like investing in things that I understand, and that's really critical. And I like investing in things that generally I can see as well. I can see it, touch it, and I know what it is. It's real, not just, you know, not just paper. Although, you know, certainly with obviously with some of the insurance products, arguably you could say they're you know, they are paper, but they are also assets and predictable assets. So
Okay, so then from that, you get into real estate, obviously inside the alternative space, you talked about especially multifamily. So talk to us about the benefits beyond just the regular return profile of
Yeah.
investing in multifamily real estate.
Well, I think, you know, the thing that people who do not invest in real estate don't really understand is it's completely unfair to everybody else who doesn't invest in real estate.
Yeah.
It's so crazy how unfair it is, right? Like the tax advantages are ludicrous. Like
Yeah.
you really, you know, I remember, and you know, there's the Donald Trump thing about him not paying taxes, and it was like, yeah, no kidding. Why? Of course, he's got massive amounts of depreciation,
Yeah.
right? Massive amounts of depreciation and that kind of thing. So, you know, listen, at the end of the day, the government rewards people who own real estate by creating significant benefits in the form of tax write-offs, even though, you know, pretty much every property we know just tends to appreciate over time. And, you know, we force value in them with value add as well. From the tax perspective, the IRS allows us to depreciate as if that's like, you know, equipment that's going to go out of business in 27.5 years. Right.
Mhm. Yeah.
And so we have that advantage. We have the advantage of, you know, we take debt, we have lots of debt, and that the amount of debt often, you know, first of all, obviously you can take off the interest, you can write that off as well. But the amount of leverage that you can take on real estate is really incredible, right? Because so if you take a, you know, $70 million building, and, you know, you may get, you know, you may end up with like 70% leverage on there, right? And then you're paying like 30%,
Yep.
right? And then you're paying 30%, you're bringing that equity from your investors or whatever. And the beautiful thing about depreciation right now is there's additional laws called, you know, cost segregation analysis and bonus depreciation that essentially allow you in some cases, in most cases, to essentially invest and write off everything that you invest.
Mhm.
Right. So, I mean, again, it's unfair. It's unfair. There's no doubt in my mind. I mean, it's like, how do they let this happen? I don't know, but I'll take it. You know?
Yeah. And in the debt vein, I've also heard you talk about the advantages of inflation as it relates to the fact that you're carrying debt, right?
That's exactly right. I mean, so you think about inflation, and again, people who are sitting on no debt, bunch of cash, what's happening? They're losing money
Mhm.
losing money every day in purchasing power. Inflation goes up by 8 or 9% in a year. That means, you basically lost 8 or 9%.
Yep.
But the beauty is, if you owe somebody money, you owe them the same amount of money regardless of inflation. So inflation erodes debt.
Yep.
And it's like printing money.
Mhm.
That's what it is. It's like
Yeah.
printing your own money. So
That's an interesting take. I like that.
Yeah.
Okay, so inside of the multifamily, you talked about the 1.5 billion that you have in the multifamily, and a lot of that is, we know, with Western Wealth, you have a great track record with them, and then obviously with other syndication groups that you're with. But what are you looking for when you put together a deal?
I mean, it's so from our perspective, it's very formulaic, right? I mean, it's kind of boring stuff. Like, it's a lot of, it's a lot of tables and graphs and understanding. First thing you're going to do is you got to start with, like, where are you going to buy the stuff? And then you have all of the demographics and the work, the numbers in terms of how many people are moving into the area, how many more jobs are coming in, things like that. Once you get down to that, then you pick your markets, then then pick your properties. And your properties are, now people invest in different kinds of properties, right? There's different business plans. And as you mentioned with Western Wealth, our big one there, and actually, with Turo as well, which is my other group, the goal is value add. Now, what does that mean, value add? Well, you can buy real estate and do what you would call maybe a buy and hope model, which is you buy and then you just collect rents and then you don't do much with it. And then you just sell it and hope that you get more than you paid for it. Or the beauty, again, with real estate is that it is a real asset that you can manipulate. And so you can get in there and you can know what the market comps are. You can know what types of rent people are getting for various types of rental properties. And if you determine that there's a lot of room on the upside, then you can go in, improve your property, and use that insider information, which is perfectly legal in real estate.
Yeah.
And you can, raise your rents accordingly. Now, what that does is it creates this opportunity to, again, because commercial real estate of all kind, it's not based on the way we buy houses. You look at a house, I think it's all, worth what they're asking for it. That's not how it works. It works basically on, you have a certain amount of income and net operating income, and that net operating income trades at a certain valuation. So if you can drive up net operating income, you can drive up the amount of value to that property. And because you have tremendous amounts of leverage, that's how you can end up routinely, doubling money every 3 years or so.
You kind of answered this in this one, but I want to just hit it really directly. I've heard you talk about being in the business of real estate versus investing in real estate. Maybe just hit on that more directly. What's the difference between them?
Yeah, I think so the way I distinguish it, so when I first started buying apartment buildings, I was kind of a landlord, right? Like, and I had property management stuff, but I was really like, still kind of a one-man show. And it's sort of like having, a coffee shop that's not Starbucks, it's just named after yourself, and you kind of run this
coffee.
Show. Buck's Coffee, right? Although I mostly caffeine pills these days, but I'm too lazy to even make a cup of coffee. Anyway, so what I realized was that, and I think if you look at it from a small scale and up, you would agree. I think most people would agree that I think often people do businesses and work really hard, and they work really, really hard, and another person works really, really hard, but they make incredibly different amounts of money, right? So in the same vein, what I realized was that, listen, you can owning an apartment building by yourself, and not having essentially a structure or an asset that's big enough to have employees, to have on-site services, and so on, you're going to make a lot more money in that property, and you're not going to actually spend any more time. You might even spend less time because all of a sudden you've transitioned from being a landlord to owning a small business, because a 50, 60, $70 million apartment building is a small business. It's not just,
Right.
a piece of real estate. It has, huge amounts of, you've got employees, you got all sorts of things going on, maintenance and, rehabs and all that. And so from a scalability standpoint, it just made sense for me to say, okay, I can spend a certain amount of time, but if I spend it on this vocation instead of the other, I can make literally 10 times as much money.
So putting that together with what you talked about earlier with the Western Wealth and that kind of thing, what makes your process unique from some of the other syndicators?
Yeah, I think for me, I think that if you look at what we've been able to do, I think our track record speaks for itself. And I know there's certainly others out there who've done it. Kenny McElroy was, a guy I feel like I learned a lot from early on, and he's a great guy, tremendous track record. But we've had 34 dispositions in the last 7 or 8 years, and we've averaged over 30% annualized returns.
Mm-hmm.
And so that's not a fluke when that happens, right? Like that's not a fluke. And you could argue we had we had some wind at our back, but a lot of these numbers were done before the inflation, the whole inflation thing really kicked in as well. I also think that we are really focused on speed, trying to get things done quickly. And the reason that that's important is that before this whole interest rate thing happened, what we could do is we could go in there pretty quickly and create so much value, essentially do some kind of a refinance program and get people at least half their money out in 12 or 18 months. And then they have the same equity, but then they take that money and put it into some other deal.
Yeah, that velocity you were talking about earlier, right?
That velocity again. And so I think that's pretty unique right now. We've slowed down a lot. I think most responsible syndicators have done that too, because the market is not really corrected for the changes in interest rates. But I do think that, and I also think that if you look at, we take this very seriously, and we have professional management, professional teams. I mean, it's like, to me, it's very different from, hey, I got a couple guys with some jobs who are, they're going to take down this $40 million building, and you guys want to invest. But, it seems funny, right? But that's kind of the way a lot of the podcast real estate, the real estate podcast ecosystem ends up being, right?
Yeah.
It's like,
so
right.
You just got to make sure you're with people who have an actual track record, right?
Right.
Yeah.
Because they do pop up everywhere. They have popped up over the last 5 years, especially.
Yeah, for sure. And the track record's important. I think some level of, listen, you gotta vet individuals. You have to vet companies and see, who they are. A lot of times you can kind of pick up on, somebody who knows what they're talking about, who's competent versus not. There's an emotional intelligence test that I think is really important when it comes to this kind of stuff as well. A lot of times you could pick up on it.
So Buck, you hit on for a second there the changing real estate climate.
Yeah.
Are there still deals in the multifamily space to be had? Do you still see opportunities in that market?
I mean, I think what's happened right now, and I was on a panel with Kenny McElroy and some others recently, and we all kind of said the same thing, which is what's happened is that we've got a very volatile lending market because of the rates. And that, that is, not consistent with what sellers are looking for, right? They're still stuck in an old, back in April or May, when they were getting a certain valuation, they could get a certain valuation because interest rates are low, right? Now interest rates are like, more than doubled. And, and so, but if you look at the sellers, a lot of them, most of the time right now, are just not being realistic with regards to, resetting expectations on what they can get. And by the way, as long as they can keep getting what they want or getting close to it, that market is going to continue to be difficult. We just don't want to get involved with deals if we don't feel like they fit into our algorithm, because we're very, data driven. And if something doesn't fit the buy box, then it doesn't fit the buy box. Now, it could happen that, we say, well, listen, normally we shoot for a certain pro forma, but maybe we should look at a more conservative pro forma, and so people can still deploy capital, and maybe they won't be making 30s, but maybe they'll be making 20s or 15s, and that's not bad either. So we may do that but I have a sense that what happens is that over time, you have a stability of interest rates. Now, in real estate, it doesn't, what the interest rates are doesn't necessarily make a big difference. What makes a difference is stability, right? Because we're a value add, we do value add real estate. So what we're basing everything on is deltas. And we don't care what the absolute number is. We want to come in and know that we can create a certain amount of value and then get rewarded for that. And that delta is where we make our profit.
So to maybe clarify one point you made there, are you saying that a rise in interest rate directly leads to a change in valuation? In other words, values have to come down if interest rates are going up.
If you think about it, right? Like, so you can't, this comes down to the simple concept of like, how much can you, what is the interest rate you're going to borrow at? And then the interest rate that you're going to have borrow at has to be less than the capitalization rate. Otherwise, you're going to magnify losses, not magnify gains.
Yeah.
So that threshold, as the interest rates change, the cap rates kind of have to change.
Yeah.
In order to facilitate that. And the problem is that they have not changed enough right now to really start buying. Now, that being said, it does create an opportunity, I think, in general, to be a net seller, which is like, what we're planning probably in the next 12 months. I think we're going to be selling a lot of property.
Yeah. All right. So we've talked a lot about the multifamily side of things, but I know you also have other offerings that you have been involved with. So let's talk about some of those. Let's start with self-storage. So I know you've done some things with self-storage. Tell us your thoughts on that.
Sort of cherry picked in self-storage. I mean, it's a business, so it's a little bit different. Not quite as much as depreciation, but it's certainly been very profitable for us in terms of our investor group. Obviously we have an ATM fund, and the ATM fund is interesting because there's a sort of a fixed return involved with that. And if you combine that with, what you guys produce through Wealth Formula Banking, the banking policies and all that kind of stuff, it can be pretty significant in terms of the IRRs that you can obtain on that. I think we have a video on that too, right?
We do, yeah.
You may want to make that available for people, because that's pretty compelling what you can do if you combine them. And, I'm looking for different things. I don't offer a lot of different, because the hardest part in investing is really finding good partners and people who can reliably put capital to work. I mean, it doesn't really help to have, if you're working with who you think are some of the best people, and then, why try to work with other people who are not as good, right? So, so that's it. Another interesting thing that I think we're going to have probably in November or so is I am sort of involved in this old Bitcoin world, some cryptocurrencies. And we have an opportunity. I think we're going to be presenting that involves Bitcoin mining and mining with alternative energy sources. So basically going into wind farms and locking up excess energy that's stuck behind the grid that they don't know what to do with, and we can use that for mining. So it's what's cool about that. Not to mention, like, I think, if Bitcoin goes up even to 30 or 40 again, the numbers get stupid in terms of returns. But beyond that, one additional benefit is that, again, it's a real asset. It's real property, not real property. Sorry, personal property. And it can be depreciated 100% in the first year. So the thing that's cool is that, say you invested, I don't know, $50,000, $100,000 into something like this, you would get a K1 in the first year showing a loss. And so that's awesome, because usually, like, I like to buy Bitcoin, but one of the things that's hard for me is because I'm so stuck in the real estate world where every time I invest, I get a deduction on my taxes. I don't get that when I buy Bitcoin. Certainly don't get that from stocks either. But if I want exposure to Bitcoin, yet I want the same type of advantage of, having real estate, this is actually, pretty cool.
Yeah, absolutely.
Okay, Buck, we can't have you on the show without asking your thoughts on life insurance. So talk to us just a little bit about maybe how you came to find the concepts and just your feelings about life insurance as an asset class.
Yeah, I mean, as you guys probably remember, I mean, it took me a while to figure out what the big deal was. I kept hearing, like, I was listening to those podcasts back in the day, and somebody would say, bank on yourself, or like, what are you even talking about? What does it even mean? Right. So I didn't really get it. And then when I did get it, it was like, oh, wow, that makes a lot of sense. With banking in particular, the idea of, again, there's so many of those elements to that belong with the wealth formula. Again, you have the mass, you have the leverage, you have the velocity, and being able to, utilize that to essentially not exchange one investment for another, but actually just take the investments that you have and actually turbocharge them. It was pretty compelling. Of course, then we got, the whole concept of IULs and, some of these indexed IULs.
Yeah, and the premium financing piece that we do.
Premium financing stuff. And again, that's very much in line with this idea of leverage for me. Now, it's a little different because there's stocks involved there, but again, I'm not saying I wouldn't invest in the stock market. I mean, if you look at it and you say, okay, it's 7 or 8%, I don't get super excited. But if all of a sudden you've got, premium finance tacked onto that, and your IRRs are, 20, 30%, then that's a little more
compelling, right?
No, it's a lot more compelling. So it all goes back to sort of this, like, people think it's kind of, maybe a lot of people think the leverage is risky, but again, I think, like, I think good debt is generally pretty safe. I mean, you got to be careful with it. Of course, it's like a bazooka and you don't want to shoot yourself. But on the other hand, if you know how to use it, and if you are using it responsibly, it can really change your life.
Yeah, well said.
Awesome. Okay, I'm going to ask one more question, then I'll let Christian take us home. And this actually leads right kind of on from what we were just talking about, and that is that you're very much legacy minded in the way that you view passing your estate on to your girls.
Yeah.
So what are some key points as it relates to this kind of legacy concept that you've learned and started to implement that people could benefit from?
Well, so I feel like after a certain amount, after I felt like I had a certain amount of wealth, it became less about me, trying to pay the bills, and more about figuring out, like, what's important to me. And, like, for me, I have 3 daughters. They're little, they're 13, 9, and 7. And, the most important thing for me is to make sure that they're secure, right? That's really important. So I think that, for me, even though there's all these tremendous opportunities with insurance products um, when it comes to say, building some kind of a retirement income and all that stuff, that is not as big of a concern for me. Like, I'm not really worried about having income. So, instead, I start looking at some of these policies and saying, well, how can I make sure that my girls, even if I screw everything up, right? Like totally screw everything else up, that my girls are going to be fine. And so I really started looking at, some of these policies from a legacy perspective more. Like, even with premium finance, the idea of course, being that you could end up with a bunch of money that you could use, but on the other hand, the leverage also over time helps you create a huge amount of insurance and payouts to your children. So if you decide you don't need to use it, it's going to go to them as well. So I think for me, like, I mean, that's been a major shift. And I think a lot of it comes down to, like, when you feel like, okay, I have enough to live and I have enough money for what I want to do. And you bring people into the world, and you have, in my opinion, some responsibility if you are able to help, pass on that wealth to them. And I think, there's obviously other advantages just with insurance, you guys talk about, and especially with the higher net worth clients that, I think are important as it comes to estate planning and that kind of thing. A lot of people don't think about estate planning, and it's the weird thing about it is that I think a lot more people are going to be affected by it than they think they are, because right now, we've got these limits. Like, if you're a married couple, it's 22 million, 11 million on your own. But that's going to go down. I mean, there's just been so many attempts at knocking that down. So I wouldn't be surprised if it ends up being closer to 5 million. And at 5 million, now you're talking about a pretty significant, I mean, probably a significant portion of my my investor group, is got a net worth of that already. And if you multiply that times, the next 20, 30, 40 years, however many years they live, I mean, they're going to be over these estate numbers pretty quickly. And that's where I think that another, that whole concept of using life insurance as part of a strategy is really, really, really important. And I personally think it's probably the most neglected when it comes to, like, I have a lot of high net worth friends and entrepreneurs, and a lot of them do use premium finance and other types of tools like this, but some of them, they just don't think about estate planning. They just don't think about it. Like, I don't know, like, people are afraid of it. Maybe they're superstitious. But it just creates such a mess for your family if you don't do it. So
yeah, like you said, and the rules are scheduled, or the limits are already scheduled to go down dramatically. So you kind of get a win on both sides, right? You can hold well, as an example, right? You could use a policy to invest through, and then you can decide later on if it makes sense to use it as an income vehicle, or if it makes sense to use it as a estate planning play. But either way, you're kind of building an asset and creating a win. Okay, Buck, before we let you go, we need a few more words of wisdom. As a successful entrepreneur with multiple businesses, how have you managed up to this point to kind of balance that balance between life and work, and being a crazy entrepreneur?
Well, I think it's, the thing about building successful businesses, I think, is a lot of work on the front end, but then once you create something, a lot of times you're, I wouldn't say autopilot, but like what you're doing is you're managing and making sure that machine that you built is functioning properly. And that's, that ends up being, a lot less work. So, I mean, I certainly don't think I work nearly as much as most people, certainly physicians and stuff that are listening to me. But yeah, I think that's also, by the way, a way to determine whether you are like a sort of a true business owner or if you just own a job, right? You own a job, yeah, you're going to work like crazy because it just, every you're getting paid for your time. But once you can dissociate that, then you're actually a true business owner. And that's, in my opinion, what the goal of entrepreneurship really is.
Yeah, you have to be able to step away from it, right?
Well, yeah, and there needs to be a dissociation between the amount of money you make compared to the amount of time you spend. There can't be a linear relationship, right? In fact, I would say that like there should be no significant relationship between those things, and that's a huge difference between somebody who works for a living and someone's a business owner for a living.
Good stuff. Okay, Buck. Well, we're going to let you go, but what are the best ways for people to connect with you?
Yeah, so obviously Wealth Formula podcast, you guys are very familiar with, wealthformula.com. We have an event coming up October 7th and 8th. If anyone's interested, go to wealthformulaevents.com. And that's going to be kind of cool. Actually, I don't know, you guys know, but we're talking in the morning, we're doing personal finance. In the afternoon, we're doing longevity.
That sounds cool.
Yeah, so it should be interesting.
Okay, well, we're excited to hear about it. Okay, Buck, thank you so much for coming on.
Yeah,
it's been awesome. We'll talk again soon.
All right, take care.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.